At the end of my last video, I promised we talk about the buyer who hears one sentence over and over again. Buy now and refinance later. And this buyer assumes that when interest rates finally come down, everything will work itself out. This is especially true for buyers who already have more debt than they would like, or the credit score isn't quite where they want it to be. Because here is the truth. Lowest interest rates don't automatically solve either problem. And understanding why may completely change how you decide whether buying now or waiting is the smart move. Let me ask you a question. Imagine you buy a house today. You stretch your budget just a little because everyone keeps telling you, oh, don't worry, you'll refinance later. 2 years go by. You've been waiting for this day. The news finally announces that mortgage rates have dropped. You smile, you're happy, you call your lender, you fill out the paperwork. You start thinking about how much money you're going to save every single month. Then your phone rings and you pick up and you hear, I'm sorry, you don't qualify. Most buyers don't think that's even possible, but it happens. Probably more often than people realize. And the reason has nothing to do with whether rates dropped or not. It has everything to do with what happened in your financial life while you were waiting. That's the part almost nobody talks about. Because refinancing isn't simply changing the interest rate on your current loan. It's applying for a brand new mortgage. Everything starts all over. The lender verifies your income. The lender reviews your employment. Your credit is being pulled again. And the lender calculates something called your debt to income ratio. Now, don't let that term scare you. Debt to income is actually very simple. It answers one single question. How much your monthly income is already committed to paying debt? Your mortgage, your car payment, student loans, credit cards, personal loans, anything you pay every single month. The lender is not asking, did rates fall? The lender is asking, is this person the one that walked into my office today for the very first time, the person I would approve this loan for? That's a completely different question. And that's why I want to tell you about 3 buyers. All 3 buyers buy a house this month. All 3 of them hear the exact same advice. Buy now, refinance later. 2 years pass. Interest rates finally came down. Buyer number 1 refinances. Buyer number 2 gets denied. And buyer number 3 qualifies, but decides not to refinance at all. 3 buyers, same market, same interest rates, 3 completely different outcomes. Why? Because interest rates changed, but so did their financial lives. Let's start with buyer number 1. Buyer 1 understood something that most people don't. Buying the house was not the finish line. It was just the beginning. Buyer 1 knew refinancing wasn't guaranteed. So instead of waiting and hoping rates would save this buyer money, buyer number one spent the next 2 years making himself a stronger borrower. Every payment was made on time. Credit card balances stayed low. When it was tempting to finance new furniture, buyer number one asked, "Do I really need this furniture right now?" When friends upgraded to newer cars, this buyer kept driving the one that already worked, even if it was older. Not because he couldn't afford something nicer, because this buyer understood every new monthly payment would affect the future options. Now, I'm not saying stop living your life. Life happens, right? Cars break down, air conditioners stop working, kids need braces, unexpected things happen. The point is not to avoid life. The point is to understand that every financial decision you make after buying your home changes the borrower you'll become. Buyer one understood that. He wasn't waiting for the rates to come down. He was just preparing for the opportunity. So when the rates finally dropped, this buyer was not nervous at all because he didn't wonder whether the bank would approve him or not. This buyer already knew he had put himself in the strongest possible position. The refinance was easy, not because the rates came down, because buyer number one became stronger while waiting. And that's a lesson every buyer should remember. Don't spend all your energy hoping the market changes. Spend your energy making sure you're ready when it does. Now, let's talk about buyer number two, because I think buyer number two is the buyer many people watching this video will recognize and can relate to. Not because buyer two was irresponsible. It's because buyer two resonates with a lot of people. Buyer two did not make one terrible financial decision. Life simply happened. A few months after buying the house, the car finally gave out. Replacing the car was not a luxury, it was a necessity. A few months later, the air conditioner stopped working. Then insurance premiums increased. Daycare became more expensive. Grocery and the prices went up. Maybe this buyer carried a little more on his credit cards after moving than he expected. Nothing dramatic, nothing reckless, right? Just life. Now, here's the most important part. When buyer number two bought the house, this buyer was already close to the lender's debt to income limit. So let me ask you something. If mortgage rates drop by 1%, does that magically erase your new car payment? Absolutely not. Does it erase credit card balances? Of course not. Does it erase higher insurance premiums? Absolutely not. Does it erase the extra monthly expenses that slowly found their way into your budget? Of course not. And that's where so many buyers accidentally misunderstand the phrase, buy now, refinance later. The lower interest rate helps, but it does not erase the financial decisions or the financial realities that happened while buyer two was waiting. So when rates came down and buyer number 2 called the lender, the answer wasn't, "Oh, congratulations, rates dropped." The lender looked at today's numbers, today's income, today's debt, today's credit, and the lender simply said, "I'm so sorry, you don't qualify." And again, it's not because buyer number 2 bought at the wrong time, not because rates didn't fall. It was because the buyer number 2 financial picture changed. That's why I always tell my clients, don't build your entire home buying plan around something it's out of your control. Now, let's look at buyer number 3, because this buyer profile surprises people. Buyer 3 did everything right. Made payments on time, credit stayed strong, the debt stayed manageable. So when rates dropped, buyer 3 applied and the lender approved buyer 3. Everything looked perfect. Then buyer 3 started looking at the numbers. Closing costs, lender fees, escrow adjustments, the new payment. And most importantly, the break-even point. And after adding everything together, buyer 3 realized something. Yes, the approval was there. He could qualify, but it did not make financial sense. The monthly savings were so small that it would take years just to recover the cost of refinancing. So buyer 3 decided to keep the original mortgage. And this is another outcome people rarely talk about. Sometimes the smartest refinance decision is don't refinance at all. Just because you can refinance, it doesn't always mean you should. And I think that's an important lesson, because somewhere along the way, real estate became full of simple answers to complicated questions. Always buy, always wait, always refinance. But guess what? Life doesn't work that way. Every buyer is different. Every financial situation is different. Every home is different. And every single decision deserves more thought than a catchy slogan. So, who should be especially careful with the advice, buy now, save later? I'd say 3 types of buyer profiles. The buyer who is already stretched financially. The buyer who is hoping lower interest rates will fix debt or credit problems. And the buyer who has never asked what happens if refinancing never happens. Because that's the real question. If buying a house only works if interest rates fall, if it only works if you qualify for a refinancing down the road, if it only works if everything goes exactly according to the plan, maybe the problem isn't today's interest rate. Maybe the plan itself isn't strong enough. Now, before someone comments, "So Monica, are you telling people to wait?" No. I'm telling people to prepare. Because here is what you actually can control. You control paying your bills on time. You control keeping credit card balances low. You control avoiding unnecessary debt. You control improving your credit score. You control building an emergency fund. You control becoming a stronger borrower. These 6 things you can control, and these decisions matter, whether rates fall next month, next year, or maybe never. So, should you buy now? Maybe. Should you wait? Maybe. The answer isn't hiding in tomorrow's interest rates. The answer is hiding in today's financial picture. So, don't ask, will interest rates come down? Ask yourself this instead. If interest rates come down, will I actually be ready? Because that's the question that may save you from making a much bigger mistake than buying at the wrong interest rate. If you remember only one thing from this video, remember this. Hope is not a home buying strategy. Preparation is. The buyers who make the best real estate decisions are not the ones who predict the future. They are the ones who prepare for more than one possible future. That's exactly what I help my clients do. I'm Monica Ștefănescu with Florida Sunny Shores. As the Tampa Bay decision realtor, my job is not to tell you when to buy. My job is to help you make a decision you'll still feel good about it years from now. Because Florida living is not measured in distance. It's measured in daily friction. I'll see you next week.